Now the topic before us is components of balance of payments. Balance of payments is a systematic record of all the economic transactions which take place between the residents of one country and the rest of the world during a specified period. It is a comprehensive accounting statement where we take into account export and import of goods and services, financial transfers, capital transfers, etc. Balance of payment follows the principle of double entry bookkeeping, where every transaction is recorded as a credit and a debit. It is the format of a balance of payments. We are showing you just for knowledge. On one side, we take into account debit entries. It is in negative, that is, here credit entries are taken into. Here we have given negative on the debit side. What is the meaning of debit? It means that all outflows of foreign exchange are to be taken into consideration. All the items where outflow of foreign exchange is there, and all the items where inflow of forex is there, foreign exchange, all the items where which result into inflow of foreign exchange, all the items are taken to be taken on the credit side, and all the items, all the transactions which result into the outflow of foreign exchange are to be taken on the debit side. First we take into account export. If a country exports goods, what happens? Suppose we in India export wheat, then foreign exchange will come. So here we will write export of goods. Goods can also be called visibles because goods can be seen, touched. If we import, what it will mean? Import means we will have to pay foreign exchange. So here it will result outflow of foreign exchange, import of goods. In the same way, if we export services like banking, insurance, shipping, etc., then it will result into inflow of foreign exchange. As we will give service to other countries, they will give us foreign exchange. So here it will result into inflow of foreign exchange. Though we are writing forex, you are to read it as foreign exchange. Do not write shortly in exams. Here it is export of services. Services are also known as invisible items. If we import services, that is avail the services from other countries, we will have to pay foreign exchange. So there is outflow of foreign exchange. Then there comes unilateral transfers, or we may call it one-sided transfers. If we send foreign grant, if we give grant or aid to other countries, these are one-sided payment for which we do not get anything in return. If we give, then it means outflow. unilateral transfers to abroad. If we give transfer to abroad, then it means that we are sending foreign exchange to other countries, outflow of foreign exchange. But if we receive unilateral transfer from abroad, gifts, foreign aid, these are unilateral transfers. Then we may be making some investment in foreign countries and we may receive some sort of profits or income or rent or dividend. So, if we receive income from abroad in the form of, say, such as rent or interest for the investment made abroad, then it results into inflow of foreign exchange. But if we have to make payment to abroad, income like rent, interest paid to abroad, if we send money abroad because they have made investments and now the income is flowing to them in the form of rent, interest, dividend, then it means outflow of foreign exchange. It is to be taken on the debit side. Then it is also possible that we may lend to foreign countries. We are having money and we are lending money. So when we lend money, what it means? Foreign exchange goes out. Lending to abroad. But if we lend from abroad, there is inflow of foreign exchange. We may be having money and we make investment abroad. If we make investment abroad, it means outflow of foreign exchange. Investment to abroad, or if we receive investment from abroad, it means inflow of foreign exchange. So in this way, it is broadly a form of balance of payments. How the entries are made in the balance of payments. This is a broad outlook. There may be many more entries which may come. We are here only discussing the broad view of the same, so that you can understand what is the format of the balance of payments. Now, some persons say that there are only two components, current account and capital account. But as per the latest guidelines of the IMF, as per the accounting standards of the IMF, what are those? We will also discuss later on. There are three components of balance of payments. One is current account, then capital account and financial account. In the current account, we discuss export and import, of goods. Then we also include the transactions which relate to export and import of services. Then we take into account here current transfers, that is one-sided transfers in the form of aid or grants. Then we here also take into consideration income which is earned in the form of rents or interest for investments made abroad, which we have, that is income which is given or which is received from abroad. Here we take into consideration the transactions related to the capital transfers or sale and purchase, or the transactions related to the capital assets. Here we will take into account the financial transactions, that is the transactions related to foreign direct investment, foreign portfolio investment, etc. We will discuss all it in detail later on. Here is the reason why we have mentioned three components. Balance of payments has three components. This is as per the new accounting standards specified by the International Monetary Fund. In the 6th edition of Balance of Payments and International Investment Position Manual BPM6, this is the manual of IMF, according to which there are three components of balance of payments. Now IMF is going to revise its manual in March 2025, which will be known by the name BPM6, BPM7. Now all these components, whether it is current account, capital account or financial account, they provide a comprehensive view of the country's economic transactions with the rest of the world. It covers export and import of goods and services. It covers unilateral transfers, that is the current transfers, capital transfers, and financial flows. Now the topic before us is errors and omissions in balance of payments. In balance of payments, we make record of all the economic transactions which take place between the residents of one country and the rest of the world during a specified period. In the residents, we include individual residents, businesses, government and its offices situated within the country. When we have to make the record of all the transactions which take place between one country and other country, these transactions are likely to be very enormous in numbers. Even for a small shopkeeper, it becomes difficult to keep the record of all its sales and purchases. But in the balance of payment, there are a large number of transactions which take place between one country and other countries as a whole and the rest of the world. So the errors and omissions are bound to happen when the countries compile their data in respect of the economic transactions with the rest of the world. Discrepancies are bound to occur due to many reasons, such as there may be some imperfections in data collection. Sometimes they have to make estimates for certain transactions. There may be difference in some compilation methods, or there may be some complexity in the international transactions. So due to all these reasons, there may be some errors and omissions in the data. When we are talking about balance of payments, as per the latest accounting standards of IMF, International Monetary Fund, balance of payment has been divided into three accounts: current account, capital account, and financial account. So in addition to these three accounts, there is also one more element, and it is known as errors and omissions. Why error and omission item is there in balance of payments? It serves as a balancing item in balance of payments to ensure that debit and credit are equal. And errors and omissions entry, there is one entry which pertains to errors and omissions in the balance of payments. For example, if this is the balance of payment record, here it is debit, here it is credit entries, and we have mentioned here, say, current account entries followed by capital account, then we have made the entries of financial account, and at the last there is also the entries pertaining to errors and omissions, so that the debit and credit is balanced. Errors and omissions reflect the inability to record all international transactions accurately. It is not possible to record all the transactions accurately. So this item has been included in the errors and omissions. Thanks for watching. If you like this course, please spare some time to give a star rating to our course.